The signals from earnings, are they good enough to keep this market rally going?
I think they are, and we have to remember that we had a pretty bad correction last year, and that was starting to forecast some pretty bad economic outcomes, really tight monetary policy, and a bad environment for earnings. And so we're recovering off of what was some pretty dire market moves. We have to remember that going into a period of slowing growth and better policy should actually be quite good for the markets. Not everyone's going to be a winner in this environment. We go back to favoring what we believe are the true growth companies, but so far the signal for earnings is generally positive.
Are you as positive, Greg? I think you're worried about margins and peak earnings growth. Has it been factored in?
Yeah, absolutely. We think not. I mean, we certainly saw after Q3 earnings releases, which were good quantitative earnings releases, the forward-looking guidance that came along with those earnings was much more conservative. We've seen the likes of Apple and FedEx guide relatively negatively around the turn of the year, and we think there are further downside risks to consensus earnings this year.
Brian, how much would the market, how many downgrades and guidance cuts can the market take at this point with current valuations?
I think the market could take quite a few. I mean, market's trading, if you look at the broad market, it's trading at average valuations. I mean, cycles don't end at average valuations with stocks. I mean, stocks are trading as cheap to bonds as they have since early 2016 and before that 2013. And, you know, it's very hard to imagine a cycle ending with an earnings yield of stocks north of 5%, a treasury yield of, what, 2.6, 2.7. I mean, it's just an environment where you're being incentivized to own equities. So some guidance down is going to be expected in a slowdown. I mean, that's what the market was telling us last year. We priced in a slowdown and perhaps even more. What that gives us is better policy, stabilization and growth, some stimulus out of China, and that should support global markets.
What do you make of forecasts that say we're 90% in a global recession now? And on top of that, how long can the U.S. stay uncoupled from it?
Well, look, what's ended up happening is if you look at most major economies of the world, they've been growing at or perhaps slightly below trend while the United States decoupled. And so the United States had a big year of growth. And what's happening now is the U.S. is converging back towards trend, where most of the major emerging economies of the world are hovering near trend. There's a couple of outliers, like a Turkey, for example. China slightly below trend because of trade concerns, but you're starting to see some policy stimulus out of China. So if you think about it from a where are we to trend, most countries are kind of converging together. And that's actually a reasonably good place because it keeps policy generally accommodative, will stabilize the dollar. The stabilization of the dollar has oil prices going back up. That's helping the credit markets, and this is why the equity markets are bouncing.
Greg, given your view that we haven't seen the worst of earnings, do you think the adjustment in equity prices that we have seen is sufficient, or do we need multiples to continue to contract?
Well, I think certainly I wouldn't disagree that equities are relatively fairly valued, but I think certainly in the short term, valuations haven't always been a particularly good indicator of short-term earnings moves. So I think just simplistically, if we see more downgrades come through, then that's going to drive more volatility for equity markets. Our year-end target for the S&P is 2580, so we could see the market finishing the year somewhere around these levels. So we're not that bearish, but we do think we'll get more volatility. And I think it's important to look at the extent of the slowdown in earnings growth that we're having. So from plus 20% last year, the market was forecasting high single-digit growth this year. That's now coming down to mid-single-digit growth. So that's an unusually aggressive slowdown we're seeing in corporate earnings.
If you look at market history, you've had only a couple of times where you've had two negative years in a row, or even a negative year and then a flat year. So those examples are 2000, 2001, 2002. We started there with valuations at, what, 30 to 40 times earnings. We have the example of 1973 to 74, where inflation went from 3% to 15%. Today, inflation's 2%. The other examples are in the Great Depression. Unless we think that this is the Great Depression, a significant bubble somewhere in the world, or massive inflation coming that's going to lead to significant policy tightening, it's very hard to envision 2019 not being a good year for markets.
That's the optimistic take. Greg, doesn't it depend, though, for your view on what sector you look at? I mean, look at the banks. Having another great day. So far for January, up 6%. Names like Citigroup for the month, up 20%. Doesn't that show you that negative expectations, whatever we got from the banks, were already in those stocks?
Yeah, I think to a degree, after this drawdown that we had in Q4, there is more negative sentiment reflected in the stocks. And one of the things that we think we could get this year is just an environment of more dispersion, so more relative winners and losers, outperformers and underperformers, rather than this kind of strong bull market that's been a rising tide for all boats. So we think we could see more differentiation this year between relative stocks and sectors.
So which one does the best in your view?
So I think that we're not necessarily looking at things purely on a sectoral basis. I mean, we're looking for pockets of equities across sectors where we think margins could be more resilient, or the buyback story could be more resilient, and looking to pair those against stocks where they have large outstanding buybacks, but we don't think they're sustainable, or corporates that already have slightly lower margins that are going to be more at risk from a margin compression from wage growth and a slowdown in top line. And we don't think those pressures are going to be felt uniformly.